I'm Chris Davis. I'm the Director of Investor Programs at a Boston-based nonprofit organization called Ceres. We work with businesses and investors, and our mission is basically sustainable capitalism, building the transition to a sustainable global economy that in which people can thrive economically as well as environmentally and socially. And I lead our work with institutional investors, and I'm the Chief of Staff to the Investor Network on Climate Risk, which was mentioned, which is about, as of today, about 107 asset owners and asset managers, including a handful of endowments, but not enough, and we need them to be more active. So if you're interested in any of this, happy to talk with you. Building on this morning's discussions, we are going to talk about some of the practice and practicalities of what we'll call sustainable investing, which I'm going to try to define it, which not surprisingly involves integrating environmental, social, and governance factors alongside financial factors. And we're going to use climate change as an example that brought us all here in different ways probably. And many of us would argue is the mother of all ESG risk issues, as Bob Litterman pointed out last night. And with the assistance of four eminent practitioners, we're going to explore how you can address climate change as an investment risk and opportunity in making investment decisions, and also including the key question of how it can affect returns. I don't get a lapel mic, so I'm going to juggle the old kind here. So I'd like to briefly, with the assistance of a couple of slides, just talk a little bit about how we think about sustainable investment, which we define as meeting the needs of current beneficiaries or the institution currently, without compromising the needs of future beneficiaries or the institution's long-term interests. So as you'll hear in the fiduciary duty discussion later, the duties of loyalty, the duties of intergenerational impartiality. It requires a somewhat longer-term perspective. We're all victims of quarterly capitalism, and as someone at one of the pension funds we work with has pointed out, the long term is not just a series of short terms pasted together any more than a marathon is a collection of sprints. You have a different strategy if you're really trying to produce returns and manage risk over the long term. And we and many in this room believe that integrating material, environmental, social, and governance risks and opportunities into your investment decision-making process alongside some of the traditional financial metrics are an important way to do that. And as Tim Smith and others pointed out, part of that is asset stewardship or active ownership, engaging with the assets that you own and trying to help them mitigate their risks and address some of these issues that they might not be addressing. It's not just about divesting or not divesting fossil fuels. This is a rich topic, and there are a lot of tools and strategies that we believe are consistent with fiduciary duty and can and should be part of virtually every investment strategy, but so to date have yet to penetrate a lot of mainstream investment practices. Maybe some of this requires generational change, I don't know, but we're starting to see some encouraging progress. So maybe on to the next slide. So one thing we did at Ceres, after having worked with institutional investors on climate and sustainability for over a decade, we were asked to try to pull together something that's sort of a guide to how these issues matter to investment, how it relates to concepts of fiduciary duty, and some practical strategies and approaches for integrating ESG factors into the investment process. We put together last year, with the assistance of my colleague Peter Ellsworth, who's here, we call a blueprint for sustainable investing. And I commend you to take a look at it. I think it's really relevant to any type of institutional endowment or portfolio. It's not a commercial, but there are copies of it in the back, and there are more, and you can get them on our website. But it talks about some strategies, and the next slide. And step one is really investment beliefs and policies, which you've heard a lot about. Trying to articulate in a succinct way how some of what's traditionally been called extra financial factors, environmental, social, governance factors, can affect investment performance and investment outcomes, and how those matter and should matter to those who are managing investments. This is not always done first. Sometimes you do other strategies and you come back to it, which CalPERS did, for example, a large pension fund. They had about 90 policies or so that had some way to do with ESG and realized they needed to pull it all together in a coherent way to give guidance to their investment staff and the people who manage their investments. So now they have a comprehensive set after a 2-year process. But I commend you to putting this down in some way. Just really quickly, the next slide, climate risk. So just to frame some of the discussion that follows, how can climate change be a risk to investment and to companies and to assets? It can be a physical risk, it can be a regulatory risk. California, which is the world's 9th largest economy, has a robust cap and trade system that's relevant to the economy and to businesses that work there. It can be a reputational and competitive risk to companies. If you're using palm oil in your supply chain that's causing the deforestation of Indonesia and the extinction of the orangutan, that may not be good for your brand. We've heard about the stranded asset and carbon bubble risk. We can come back to that. Water is a huge climate-related issue. Water scarcity as energy production competes with agriculture and domestic use in many places. And another important way to think about climate change is a huge systemic economic risk that could affect every sector of the economy that we're invested in, can affect every investment portfolio, can be completely disruptive, and exactly how it's going to play out is uncertain. But it would seem prudent to take steps to manage that risk and to try to invest in the solutions to it. So I'd now just like to briefly introduce our panelists, and I want to ask them a series of questions to try to illustrate some of these points. And if you have burning questions, please raise your hand, and we'll allow some time at the end as well. So their bios are in the materials in the order in which I'll ask them some questions. Geeta Aiyer, president and founder of Boston Common Asset Management, which is a prominent and accomplished sustainable and responsible investment firm. Ken Locklin, who's managing director for North America of Impax Asset Management, which is based in London and has been investing in environmental strategies and solutions for more than a decade. DonnaSelva, who's an investment consultant at Prime Bucholz and Associates, who works with a number of endowments and foundations on these very issues. And finally, Mark Orlowski, who's the founder and executive director of the Sustainable Endowments Institute, a special project of Rockefeller Philanthropies, and he has focused on campus investments in greening and energy efficiency and campus revolving funds, which is another way to invest in solutions to these challenges. So first, I'd like to ask Geeta to talk a little bit about your general approach to environmental and social issues in identifying investment risks and opportunities. How do you decide which ones matter, and how do you go about addressing them?
Thank you, Chris. Thank you all for being here. I wanted to take a moment to tell you about a path by which I came here, because I think it's germane to, so you know where I'm coming from and where I think you're going. I came here in 1983 from India, having worked in rural India, to go to Harvard Business School and then joined Cambridge Associates for 3 years and have been a money manager since 1988. So for 25 years, and I've had the privilege and good fortune to work with sustainability issues in South Africa. Actually, I worked on the report on South Africa divestment as students were building shanty towns in the 80s when I joined Cambridge Associates, and subsequently have had the luxury of working in active portfolio management ever since. The reason I bring this up is that, as you know, I then became an Indian American. And that hyphen there, it means everything. Because that hyphen there is where you spend your life. You are never completely good enough to be Indian, and you're never completely good enough to be American. And you cannot compartmentalize, and you must integrate, and you kind of can never maximize. Because when you maximize the one, somehow you're not maximizing the other. So join the club, intentional investing. There's a hyphen for you. You will be tormented by saying, I'm not doing enough on the one side, And there will be others who say, you're not maximizing on the other. And I will come back to speak to what does maximizing mean anyway, and what choices do we make all the time, and how do we really get the best composite set of allocations that make us complete. And we do this when we hire people, we do this when we recruit students, we do this when we build a student body, we do this when we build an endowment. Many strokes, all combined, what was that, chorus? But I also wanted to say that we each are also many people, and therefore use many parts of ourselves to make this happen. So call on all of those as you enter this hyphen. And with that, I want to go to my slides, if someone could put them up, please. When I came here and I joined the investment business, they said, please lose the Indian sing-song and learn sports. So you will see, in my presentation elements of both. Please bear with me as I show off my knowledge of American sports. I start with the Canadian, but I think you know where I'm going with this. If you have a question, raise your hand. If it's back to the sing-song, signal to me somehow, so I will make it. The other thing was don't talk with your hands, which I keep forgetting. So what I wanted to say is that we are, to answer many of the questions that I heard and to go there in taking Chris's question, 70% of our investors are institutions. Hampshire College, I'm proud to say, is a 17-year client of ours. We manage international assets for them. We are active managers. We use judgment in everything we do, and we are activist managers. So all my biases will show in everything I say. I believe that investing is for the long term, that you always are charged with making decisions under uncertainty and incomplete knowledge. Therefore, you're always looking for corroborating evidence from whatever sources it's available to you. And if you say, I'm a good fiduciary because I wear blinkers and refuse to look at data from other sources that have not been legitimately vetted and approved of, then you are foregoing the opportunity to get corroborating evidence and also make judgments that will lead you to be a little bit ahead of, and follow Mr. Gretzky to where the puck is going to be. The second is that we think global sectors are relevant. We look for leaders and laggards. Clearly, we are interested in picking 60 or 70 great names, so we're looking for lots of reasons not to own a whole bunch of companies. People ask, do you divest or do you invest? Every decision to invest is a decision not to invest in something else. There are a few thousand stocks out there, and so obviously at all points we're using judgment to figure out what would make for a great investment. And I would say Wall Street misvalues both the risks and opportunities available in environment, social, and governance in terms of the timing as well as the magnitude. If you're waiting for things to become material and documented and known to all, you are late. That puck just went by. Next slide, please. I think one of the issues that has come up, if I can keep going, sure, with the energy question.
Talk about climate and energy and carbon.
Sure. We do manage money for those who wish to divest. We have done that for now 5 years, and we can talk about our records are similar to the previous panel's discussions, not different from ours. But I wanted to say there are ways in other ways to look at it. We do favor best of class. We seek substitutes. And the substitutes may be in factor terms in any sector. You need to use your imagination and be more complete and imaginative using all the judgment that you have in doing this. We pursue solutions and we engage in dialogue. And some of our dialogues have been with banks, PNC Bank, asking them why are they, how are they taking into account the fact that coal will be regulated and that it's a dying industry, and not only are there loans to that industry, but also their lending portfolio overall needs to reflect this. So we have a big systemic change to accomplish, and every single industry, it's not engagement versus divestment, it is and. Remember that hyphen, that's where we live. Let's keep going, just because I know your time is short and we have 4 of us. I will not try to walk you through every single dot on this. I just want to assert, I will happily share offline with you any returns history. We have, over the long term, outperformed on international, on US, and we manage emerging as well as global market assets, and we would be happy to speak to any of that. Keep going. I think that if anyone feels that pressure to match or outperform, actually I was going to ask the people under 30, do you know who this is? But this is Gloria Steinem, not a sportsman at all. but in my mind, a very leading figure because we have spent all these years. When I heard her 20 years ago, she said, we spent all this time proving that women can do men's work. Now we have to prove that men can do women's work. And I want to use that analogy to say we have proved.
Wall Street can do ESG, right?
Yes, there you go. That the mainstream can come to this. We have proven over and over that ESG can return results. And our failings and our successes are similar, meaning if I get the interest rate call wrong, I am hurt as much as the next money manager, and conversely, if I get it right, or if I get the direction of energy right, any of those calls are similar. So we have the same ultimate challenges. It's really a question of what do you do with the overall knowledge, and I want to slightly cast a little doubt there about benchmarks and whether they truly represent your opportunity cost. I mean, it's a useful thing. Everybody needs a benchmark. You know, people say jump, I say how high, and I need a benchmark, you know. But at the same time, I want to call your attention to the fact that, you know, names like, this is outside environment, but, you know, Walmart versus Costco, let's say, the two stocks have diverged for 5, 10, 15, 20 years. If you have held them equally for 5 years, you've made 3 times as much in Costco. If you held it for 10 years, it's 6 times as much in Costco. Yet the benchmark would hold you accountable to holding 2.5 times as much Walmart as Costco. And I use this example deliberately because externalities come in many forms in that they are, I believe, socializing the externalities of employee costs by having on their website how people can collect food stamps versus a Costco, which recognizes that the first person you walk into in a store and encounter is actually that low-paid, unhappy, worried, anxious, next slide please, anxious employee, and that's the front line of their performance. The future ain't what it used to be. I couldn't resist Yogi Berra, and I wanted to say that you and us, we are all charged with managing under uncertainty, and the pressures of the present cannot overcome the salience of the long term. I did want to give you I have lots of other things. You know, look for allies everywhere. Tobacco was divested by Derek Bach, citing the input of a doctor's organization. You know, we might have allies elsewhere, then we know where to look. And secondly, I think I want to call attention to all the consultants here that although we have purified and refined our ability to use investment guidelines to address inflation and deflation, there are a couple of other dangers out there. They're called devastation and confiscation. And we have had the liberty to live where these have not mattered, but there are indeed many broader calls to update our overall investment guidelines, thereby changing even the benchmarks to which perhaps you hold us accountable and what you charge us to do. I'm going to stop because I know time's up.
Thank you, Geeta. Maybe turning to Ken now. Ken, I'm going to ask you to address a couple different things, one of which is, you know, there's been the call for divestment. There has been interest in fossil fuel investing. There's been an assumption that taking that 10% or whatever it is out of your portfolio of oil, gas, coal, and electric power companies would compromise returns and be inconsistent with fiduciary duty. And you did one of 4 or 5 studies that tried to look at that issue. And maybe you could share what you did and what you found briefly before we move to the other side, which is in investing in solutions.
Right, thank you very much, Chris. Just to help frame the introduction that Chris provided, as he pointed out, we are a London-based investment advisory firm. We're 15 years old. We manage $4.3 billion worldwide in 23 different funds. All of them are fossil-free, and they have been since inception because that's the universe in which we invest. We were thinking about the issue of divestment last year, early actually in January last year, and wondering whether there was anything interesting that we could learn. We're investment advisors, we're not research analysts, we don't have the staff that Tom has or the resources, but we did a little bit of research using initially Tom's numbers, and we looked around at some other folks who have been doing similar research, and we saw that there have been a total of about a dozen studies addressing this issue in one fashion or another. We found 4 that we thought were particularly interesting because they simply had the same graphic format, which I'm going to present today, but the others will show you similar results. They simply weren't presented in a way that would line up neatly on the screen. And I hope that they'll give you a sense of why we think this question is effectively put to rest at this stage. So if I got the first slide, please. So this is the result of the first study we did in April, and in each of these cases, we're not going to spend a lot of time looking at the data, and I'll be happy to provide the papers that go with this. We're not going to spend a lot of time even looking at the slide, because what the slides are going to show you is you can't see anything. There are 2 lines up there. And that particular study is our going back and looking simply at the MSCI ACWI and MSCI ACWI X fossil fuels. So pure data, nothing to do with our performance or activities at all. May I have the next slide, please? So the next slide is actually one that Tom's team, Tom Ku's team did, and they put this together just a month or so. We saw it at least a month or so after that one that you saw before. And again, you can't see the difference. In between this study and the next one I'm going to show you, which Tom did, there was a study that came out from our friends at Apereo, and Paul Soley is coming in just on cue. A very interesting study. It simply doesn't, similar results, it just doesn't have this graphic format, which is why I couldn't include it. Next slide, please. So now we have a 10-year study. The last one was 5, a 10-year study, which MSCI did working with an ex-fossil fuel list coming from the large California state pension, CalSTRS. Same issue, 1 line. And the next slide, please. And then this piece of work was done in July. This one goes back 22 years by Advisor Partners. Advisor Partners is a purely commercial index creator fund advisor. They were asked to do this work because they are not involved in this universe or set of questions at all. They were fascinated by the research that they did and the results. And I think it says in the top someplace, there really is effectively no impact to go ex-fossil fuel over a 22-year time frame. If you came in and out of fossil fuels at the right times, you could have made a lot of money. That's true of every sector in the economy. If you bought and held, which has been the traditional pattern of most people who invest in fossil fuels in the foundation and endowment community, the result, in fact, was not important to the overall return of your listed equity portfolio. So hopefully this provides a little bit of background for those of you in the audience who have to make these decisions. If there is an interest on the part of your board or other fiduciaries in looking at the idea of reducing your exposure to fossil fuels, you can do that without prima facie feeling that you are directly contravening your commitment to act as a good fiduciary.
Okay, Ken. So Impax, you've made a career and your colleagues in environmentally themed investing in solutions to climate change and resource scarcity. Can you talk a little bit about the investment case for that strategy, and how's it gone?
You know, it's really an interesting question, and we're going to talk just about broader index issues, and I obviously would love the chance to talk to any of you about our specific performance. But the key, I think, for everyone here to understand is the range of opportunity. And each of us who work in this arena know that it's not a question of just making investments in wind turbines or solar panels. And we'll look at the impact of that in a minute, I think. But when we started doing this work more than a decade ago, we realized that the low carbon pathway, tackling the issues associated with climate change through a wide range of low carbon investments, implied doing a lot of different kinds of things. And in fact, we would argue that there are 20 some odd subsectors within which one can invest and have very direct low carbon impacts. And the key to being successful, we believe, in following this kind of path is to have that diversity, because those subsectors include some that are very cyclical. Renewable energy, solar panels are cyclical both because they're correlated with demand for energy and because they're correlated with government policies, and others that are very defensive and allow portfolio managers to seek shelter when markets are moving against the more cyclical investments. So if we could have, all right, good. So the next click will show you the same slide. Every one of the green, you're going to see some subsectors in which we invest. Every one that turns green, we believe, is a direct low-carbon investment opportunity. So obviously renewables and energy efficiency, which is a big part of our business, that's not a surprise. Next slide, please. When we look at the water sector, where we also have a lot of investment, those are the subsectors. Next click. And you'll see that the majority of those, except for water utilities, we see as having very direct correlations with the carbon generation And it's important because a number of those subsectors are quite counter-cyclical and are advantageous to be in when it's not a good time to be investing directly in energy generation. Next slide, please. And so now we have recycling, resource recovery, that whole subsector. Click, please, thank you. And again, a number of interesting areas. Particularly important here, many of these subsectors are extremely defensive. Their companies operate under really long-term 10 and 20-year contracts. Terrific place to be holding assets if you're a listed equity investor when we are at 2008, 2009. Next, please. And on the agriculture side, a new area for us just in the last year and a half. Next click. Really every single one of the major agricultural subsectors has a direct impact in the way it operates on carbon pollution from a global perspective. So we would argue that being able to design a portfolio across the width of these subsectors, and this is how we characterize them, you can look at a similar list composed of slightly different individual elements, gives investment professionals the chance to build a robust portfolio and generate the kinds of performance which we're all demonstrating. Because I think it's very important that people leave here saying, well, at least the people in the room today said that there wasn't a cost in return associated with this path.
So just one real quick one, Ken. A lot of people in the mirth of the earlier part of the mid part of the last decade invested in clean tech, and we've all heard about Solyndra and some of the solar companies, some of which I used to represent, that are no longer doing business. Are you telling us to invest in clean tech again, and sort of what's different, and why is this not a perilous strategy?
So Geeta has been very personal in her comments, and I didn't have any personal remarks, but I'm going to pick one up on this point because I think it's worth knowing. So my background is in renewable energy. I spent 25 years working on renewable energy investment. I did that because I was driving home from the hospital the day our first child was born, our daughter, and I had a panic attack, had to pull off the road because I realized I would not have a good answer for her to the question, why do you do what you do, Daddy? And I was working in development finance, which I thought was pretty progressive. But it occurred to me that a child who was going to grow up in the 21st century would think that we are all brothers, which I thought was a big insight in college, would be such a silly idea. She went to a public high school where there were kids from 43 countries. So that's exactly her reaction. That's, of course we are. I wanted to do something that was relevant to her, and I came back to the hospital that afternoon, walked in to see my wife holding my lovely daughter and said, hey, guess what? I have to change jobs. And it didn't play really well, actually, but we worked it out. The point is that renewables are an incredibly exciting opportunity, and they really were where I committed myself. So when I started to work there, I ran into a guy I was managing a fund. I ran into another guy who was managing a fund, and his name is Ian Sim, and he is the founder of Impax. And I said, listen, Ian, you don't want to do this listed equity stuff. That's really boring. You want to be, the sex appeal, it's renewables, it's emerging markets, that's the place to be. And he said, yeah, but what happens when the market turns against you? How do you protect your investors? I said, not going to happen. This is the wave of the future. I'm talking about 1998. This is the wave of the future. Don't worry about it. We're all set. I wasn't right. I'm working for Ian now. So there is an importance to take a broader perspective, and you can see that very nicely in the following slides. Next slide, please. So we're going to look at slides that show you, there we go. We're going to look at slides, and one more click. Oh, that's not a very good color. All right, for those of you who have better color vision than I do, you can see that is the Wilder Hill NEX, Bloomberg New Energy Finance NEX index. It's the best general index of renewable energy stock performance over time. Had a terrific run. I actually went to the founder of Bloomberg New Energy Finance, told him I wanted to invest in it way back in the beginning. He said, don't do it. You've got too much at stake in this industry already. He was right, because I would have wound up down at the bottom someplace. So that's the performance of the renewables over time last decade. Next. There we go. So that is the MSCI All Country World Index over time, the general, like a Standard & Poor's, general index of market performance over time. And you can see that the renewables left the standard index way behind for a while. And renewables are still trying to claw back to where they were when they launched into the market. So it's very important, even those of us who love this industry have to understand what the limitations are. Next slide, please. So that line on the top is the line that represents the performance of an index put together by the index provider FTSE, competitors of Tom's, and FTSE put together something called the Environmental Opportunity All Share. So it's an index composed of a large group of companies, more than 400, which are actively involved in the broader environmental markets space. That index, over time, has materially outperformed, obviously, the renewable index, even though it was lagged it in the peak of the solar boom years, but it's also outperformed MSCI World. So our perspective is there is an opportunity for investors working in this arena. And there are companies like the ones you're hearing from today who have established track records, 10 years, 15 years, working in this space. There may not be thousands of them, but there are dozens, and we're well positioned. And I hope that all of you will take that information and bring it back to your discussions when you're talking about fiduciary responsibility issues, and say to your colleagues on the investment committees where you may sit, you know, there's a different side to this. At least let's engage that part of the conversation.
Okay, and just a comment here. A piece of work that Ceres recently did that we released in January is something called the Clean Trillion, which is a report on filling the global clean energy investment gap. And basically the International Energy Agency concluded that between now and 2050, the world needs to invest an incremental $1 trillion a year in clean energy solutions, renewable energy, all the technologies that Ken has talked about, to avoid catastrophic climate change. So there's a huge capital need, and there's also, I'd submit, an investment megatrend in the transition to a low-carbon, clean energy economy that some of these themes play into. So we're bullish about the general opportunity. So now let's move to Alice. Alice, you advise a number of the endowments represented in this room, the institutions, and a number of foundations. What are you hearing from your clients about climate change, ESG issues, and what are they asking of your firm, Prime Bucholz? What are you telling them about, like, where to start in addressing these issues?
I think we're hearing some of the same questions that you're all asking today, which is, you know, am I going to underperform if I divest? What's going to be the impact? But I think what I hear today and what I hear in the office is that there's a number of stakeholders that everyone in the room is dealing with. And so they're also concerned about impact over the short as well as the longer term. So I'm actually going to probably confuse everyone right now by asking if you could put up the last slide I have, which I think is number 4. And what we did, one of the foundations that we work with was looking at the issue of divestment. And so they said, what would be the impact of divesting from the filthy 15 and consumable fuels altogether in the domestic equity? And if we had to underperform for some period of time, how long might that be? Because they have people to answer to, and they are a foundation that's winding down over time. So it was very important to them not to hit one of these periods for too long a time. So with the help of a Aperio, also mentioned by Ken just a few minutes ago, we put together some data. And what this shows is the Russell 3000 versus the Russell 3000 without consumable fuels. So actually, I should flip that around. So when the green is on top, the Russell 3000, which is a domestic equity index, broad index, most of you know, it outperformed without consumable fuels. So when you took out the consumable fuels, you did better than the Russell 3000 whenever the green is above the line. And when the green is below the line, having those consumable fuels in your portfolio was beneficial to you. What we plotted on the red line was oil spot prices. So you can see that I think it was around 2003 to 7. Those oil prices were flying up. And I was with Hampshire College at the time, and we were in a FTSE index, and it had very low energy exposure, and we had to suffer through that for a few years where they were saying, you know, why is this underperforming? And we were saying the same thing every time. You know, you don't have energy exposure. So it just gives you a sense of long term. You can easily make the argument that being without fossil fuels in your equity portfolio is not going to hurt you. Are you going to have short-term underperformance? Possibly, but you can see how short-lived that was. So if you can go and live through that with your committee, and if your committee can live through it, because sometimes committee members are only on the board for 3 years, and they're concerned about what their performance will look like and who's going to hold them accountable, you can kind of explain what's going on here. Oil prices are going up, we're out. Over the long term, we're going to outperform. And so what I've found also, as clients are coming to us asking for their exposure. That's been the first question for everyone, the first thing they want to know. And so if you can flip back a couple of slides, I can show you one of the things we've done. Up one more. Oh, nope, I'm sorry. Yes, right there. It's very simple. It should be, if you have an investment consultant, to know exactly what your exposures are, and that's an important place to start after you know what your values are and what missions you want to accomplish, what your mission is that you want to accomplish. So if you look at this chart, this is an actual client of ours, and we divided their portfolio up into segments, and I just have managers listed here for anonymity. The percent of fund is the percent in that manager's fund of exposure to fossil fuels. It says energy exposure, but it was actually, we did the consumable fuel industry. That was what they were most concerned about. So you can see at this time, they had a few managers that had 1% or less. In their total fund, and we looked at all equities and all fixed income in this slide, they had a 0.33% portfolio exposure in their total fund. So you have to balance that with what are you asking? Do you want to divest? Do you want to put your energy somewhere else? They clearly have moved along the lines towards divesting. This is a client who would like to be completely divested of fossil fuel stocks. And in their Filthy 15, that's the coal industry, essentially, they had no exposure. So it's important to know your exposures and where those play out the most. Where we find them playing out the most is in the index fund. Most of your small cap, active managers that you may have in your portfolio is what we call satellites around that index. They're not playing in that space. And a lot of hedge fund managers, they don't want to have a long position in Peabody. They might short Peabody, but they're not out there. So the most exposure we find, we've done about 25 exposures analysis for clients this year. About half of those have been to consumable fuels. That's been the question. Other ones they've asked is firearms, with the horrible incidents that have happened this year. Some alcohol and tobacco from our health clients. So when we've done those exposures, by and large, we found that your most exposure is in your index fund. And an index fund is a pretty easy solution. And Aperio has put together, and any good manager who will optimize your portfolio can put together an index for you that rids yourselves of the consumable fuel industry and still maintains low tracking error to the benchmark you're trying to reach. So for this particular client, we had actually asked Aperio to put together a Russell 1000 index, an index that would track the Russell 1000, but that would increase revenues to environmental innovation from 2% that's in the Russell 1000 index right now to 20%. So that was a conversation we had over time. They first came to us, I think, with a global portfolio, and it had like 50% exposure to those revenues, but the tracking error was like, I'll wrap up. The tracking error was like 7% and not acceptable to the client. So we asked them, can we bring that ratio up? So not only did they get rid of consumable fuels in that index portfolio, but they increased their revenues from positive things based on work done, I think it was by MSCI as well as Aperio. So it's an easy place to make a change.
There were a couple of other points you wanted to make, and maybe we can borrow a little time in terms of the advice and the takeaways you'd give. And also, maybe you could comment on, we've talked a lot about equities and companies, and there's other asset classes out there too. Can they be part of the solution to someone who wants to invest in ESG?
They can be part of the solution. I'm going to make my pitch right now. My pitch is that managers respond to you. So what we've found when we've looked at the universe is that it's not that the universe is limited by number of companies that are worth investing in if you don't invest in the consumable fuels is that the manager space, with the exception of the fine people right here, is limited. So ask your managers what they're doing and how they're incorporating this into their practice. If you do nothing else this year, I would go out and ask the managers. And that is by way of saying, yes, there are managers in the other space, but it's limited. So we have 2 hedge funds right now that we feel comfortable with that are long, short, direct hedge funds. You need to be comfortable with the fact that they may short an industry in renewables because they feel like it's not a place to be right now. So they're good managers. We feel they've made significant advances in this space. They're knowledgeable, but you have to be ready for that. We've actually reached out to a very well-known hedge fund manager who recently was quoted in the Men's Journal as saying that a separate account is run for him. He used to run a very large hedge fund out of the West Coast that most of you probably have heard of. And so he was quoted as saying that they run a separate account for him that is environmentally friendly. So we called the manager and said, would you run that for others? And that's the kind of thing you have to do. You have to let them know that you're interested. And that will grow the space. So with the fixed income, you need to be a little innovative, be willing to have some other things in your portfolio. There's a local manager from Boston, Breckenridge, that runs a very interesting portfolio that's a mix of municipals, which most of you would not consider, as well as corporates. But they've done a great job in looking at a variety of factors and putting together their own proprietary database on different environmental factors. As World Green Bond Funds is another fund. If you go outside the U.S. and you have the capacity, I know some of you are concerned about commingled funds. There's UCITS. They're called UCITS in Europe more often. There's more activity we find in Europe, in London, because this has been an issue for a longer time period. Yes.
Many of our members are buying green bonds issued by everything from the World Bank to corporates, where the proceeds are dedicated and ring-fenced to be invested in particular kinds of environmental solutions. So that's in many instances a no-regrets strategy in your fixed income portfolio of getting exposure to solutions to some of these issues. And that market, it seems to be ready to just grow exponentially. So moving to Mark, sort of a different approach to investing and a complement to a holistic sustainable investment strategy. You've worked with a number of institutions on investing in their campuses. Can you talk a little bit about that and what the investment case is that you found there?
Sure, absolutely. Thank you, Chris, and good morning to everyone. How's everyone doing today? Good. So my background is sort of campus sustainability and the intersection of campus sustainability and endowment investment practices. I got my associate's degree at a little community college out in Western Mass called Berkshire Community College. I got my bachelor's at a liberal arts college also out in Western Massachusetts, Williams, where I served on the advisory committee for shareholder responsibility. Some of your campuses may have similar committees that advise the investment committee or your board on issues related to environmental, social, and sometimes governance issues. So that was a fascinating experience as an undergrad just over a decade ago now, serving in that role. And since then, I've gone on to serve on an investment committee that manages a New England yearly meeting of friends, the Quakers Pooled Fund. And I served on that committee for the last decade and just actually stepped off, term limited out, eventually serving as clerk/chair of that investment group, managing money for Quaker meetings across the region. My work with the Sustainable Endowments Institute is really focused on the intersection of how we sort of advance campus sustainability issues. Many of your campuses have sustainability coordinators or directors. Many have signed the President's climate commitment. Many are already making strides towards increasing your campus sustainability programs and activities and reducing your carbon emissions. Fewer of you have connected the dots between what's happening on campus and what's possible with the endowment. There's obviously a lot of talk around divestment right now. And whether you're for divestment, whether you're against divestment, whether you're on the fence, I think a much more interesting and informative question is about the reinvestment side. Yeah, you can divest, but ultimately, even if you're a Harvard or a Yale, it's a drop in the bucket, right, compared to the $130 billion that the fossil fuel industry made in profits last year. It's a drop in the bucket. So what happens with that, let's say, $1 million or $5 million or $25 million that you might be able to to move, or even if you don't want to divest, what you might be able to reallocate within your existing investment strategy. We launched a program 2 years ago called the $1 Billion Green Challenge. Website for that's greenbillion.org. And it's an effort to encourage colleges and universities and other institutions outside of the higher education space, but mainly colleges and universities, to invest on campus in their own facilities, to upgrade buildings, to reduce energy consumption, and to generate some really great returns with, by the way, very low risk levels all at the same time. So how many of your campuses plan to be around, say, 10 years from now, for those of you who are on a campus? Show of hands. No, seriously. 20 years? Yeah, still same hands? Okay, good. Now, how many of you have deferred maintenance backlogs? Anyone have deferred maintenance back? Okay, same group of people. Now, investing in energy efficiency doesn't solve the deferred maintenance problem. I know, some universities have $1 billion or more. I was talking to a trustee from the University of North Carolina recently. They've got about $1 billion, I believe, in deferred maintenance backlogs. Just in their system alone. There's billions upon billions in deferred maintenance. And energy efficiency and upgrading buildings won't necessarily completely cover that, but there is a part of that. And so the Green Revolving Fund model really is about fixing what you could basically call about sort of an accounting error or sort of a misperception of these types of projects. If you put, let's say, $141,000 into a lighting upgrade, like George Washington University did a couple of years ago, through their Green Revolving Fund, which I'll explain what it is later, and it generates $100,000 a year in energy savings. Did you spend $141,000 or did you invest $141,000? No one knows, really? No. Okay, so you invested, right, $141,000. And George Washington has a Green Revolving Fund, so it actually was an investment. It was loaned out from their internal revolving fund that was able to put up the money to cover the entire cost of the project and then recoup the savings from the utilities budget, thereby sort of solving this accounting issue, because really most of these projects shouldn't be going up against your other budget priorities. It's not a matter of, should we make sure we have enough money for scholarships or faculty salary or maintaining sort of the grounds or keeping the lights on, or should we do energy projects? It really shouldn't be a zero-sum game. There's really an opportunity to do both. And even in a tight environment where budgets might be getting cut or need to be held flat, even dealing with inflation and other rising costs, revolving funds can step in and play a really interesting way to pull in capital from a variety of sources to actually invest in those projects and then capture those savings and realize those savings both in terms of your utilities budget and back to the revolving fund, so that you can use the same capital to invest and reinvest in more projects. Our $1 Billion Green Challenge program has over about 50 colleges and universities across the country participating right now, over $80 million committed. And basically the way a revolving fund works, each of these institutions has a pool of money, an account within your existing accounting system that basically loans out money to do projects like that lighting upgrade. And what it does is it loans the money, and then once the project is completed, tracks the savings and returns the savings back to the revolving fund to repay that loan, sometimes with interest, sometimes interest-free. You can use capital from a variety of sources. You can use operating dollars to seed the fund. You can use donor dollars. There's one school in Georgia that's raising $1 million for their revolving fund, including from a variety of donors from across the political spectrum, including one libertarian conservative businessman who really doesn't believe the climate science fully, hates Al Gore, but wrote a big check to help support the revolving fund because of the business case there and the win-win sort of performance that can be achieved. We're seeing median sort of payback periods of 3.5 to 4 years on these projects. So there's a really quick turnaround and payback there. Other schools are investing money from their cash reserves or from their endowment. Caltech currently is in our program and has $8 million invested from their endowment into their revolving fund. Just up the road in Burlington, Vermont, the University of Vermont has the largest revolving fund in higher education, $13 million right now, which I presume will be eclipsed soon. Harvard had the largest fund for many years at $12 million. Still exists, still going strong, seeing 30% a year return on investment from that fund. University of Vermont borrowed $13 million from their cash reserves because they realized we could get a better return on investment from investing in our own campus facilities than we could with our traditional cash reserves investment strategies like bonds and treasuries and other fixed income investment funds. So they're earning a 5% interest rate on that money that they're lending to themselves, whereas their other cash reserves are earning about 2.5%. And that's, by the way, that $13 million represents about a 10% overall asset allocation of their $130 million or so in overall cash reserves. So pretty substantial. There's a number of colleges and universities actually in the room that already have green revolving funds. I know Green Mountain College has a revolving fund as part of our program. Hampshire does, Middlebury, Harvard, Portland State, Unity. are all part of the $1 Billion Green Challenge program. There's some other prominent schools that some of you may have heard of that have revolving funds. I know Dartmouth, Princeton, Penn, and others also have revolving funds. There's about 100 colleges and universities around the country that have these funds and are investing this money, and well over $100 million invested. The other part of this is data, right? Because we can talk about this in a sort of generic form. We can talk about single projects, but we really want to dig in on the data side. And so over the last couple of years, through support from the Kresge Foundation, the Rockefeller Brothers Fund, the John Merck Fund, and some others, we've built a web tool called the Green Revolving Investment Tracking System, and it goes by GRITS for short. And so on Earth Day, in a few weeks here, we're going to launch GRITS 1.0, and the tool is designed to manage and track all of this project-level energy, financial, and carbon data, so that you have a web tool where you can keep track of all that, track the performance, project out the overall financial performance, the net present value calculation, the internal rate of return, the simple payback period, as well as the carbon savings that you'll be able to generate from specific projects. And so if you want to know more about that web tool, it's on our website, greenbillion.org. The last thing I do want to mention is we've been talking a lot about different policies, investment policies, shareholder engagement, committees on investor responsibility. If there's folks here that would like to know more about which schools are doing what, most people in the investment field might refer to the NACUBO endowment study for a lot of great data on asset allocation and other investment practices. As you may have discovered, there's a lot less information when it comes to environmental, social, and governance topics in the NACUBO endowment study. So we looked at the best really available resource out there, which is STARS. This stands for Sustainability Tracking Assessment Rating System. And STARS is run by ASHE, which is the big association for the advancement of sustainability in higher education. There's almost 300 colleges that have submitted and self-reported on a broad range of sustainability practices and policies, including 6 credits related to endowment investment practices. So we're going to be publishing a report later this month focusing on endowment best practices. But what I brought with me today is a little handout for those who want to come up and grab it afterwards. It's 8 pages, and it's got about 282 schools on it, listing everything from which schools have a committee on investor responsibility to which engage in shareholder advocacy, which have positive sustainability investments, student-managed sustainable investment funds, sustainable investment policies, and also have investment disclosure of their endowment holdings. So it breaks it down school by school, and so if you'd like to grab a copy of that, please come up afterwards, and happy to share the full report when we publish it later this month. So with that, looking forward to questions. And
Thanks, Mark. Well, 30% returns, I heard you mention. I don't know how many of our managers are returning that amount, so something to think about. We have a few minutes left. Do any of you have any questions you'd like to pose to the panelists? Yes? Sure. So the question had to do with investing in the community in which your campuses are located. Do any of the panelists have experience or perspectives on that as an investment opportunity or strategy?
I can speak to it if no one else will.
I think that just from our perspective, I would say that it's a necessary consideration, but I don't hear many of our educational endowments dealing with that issue yet. I think that they have their focus has been on their campus and on their own students and trying to improve that experience. So it's certainly something that we should be bringing up and raising. You may have more experience.
Yeah, I mean, I've been to over 100 college and university campuses in about 35 states around the country, and yeah, I can probably count on one hand the number of college and universities that have done any kind of investment from the endowment in community development financial institutions, known as CDFIs, or community development loan funds. It's a tremendously important area. On the Quaker Investment Board that I served on, we had a 2% allocation towards community investment in New England, which was still a very small amount, but I know at my alma mater, Williams, there's a social choice fund, which is a separate donor option that's invested separate from the general endowment pool, and 10% of that is in a community investment fund. But that turns out to be about a 0.0000001% of the overall Williams endowment, so a real rounding error, unfortunately. And many community investment work that has happened in the college and university space has been on the sort of charitable side. It's come out of operating dollars and hasn't been thought about as investment. Harvard and many others have done work even with community development loan funds, community development financial institutions, but it's been, again, money sort of along the lines of pilot, right, payment in lieu of taxes programs. That's where it's really come out of typically and not as an investment strategy.
I see it much more in foundations. Now that I think about, as Mark's going through it, I see that emphasis in endowments and in investment in CDFIs and making loans to local community projects, not so much at the educational endowment level.
Another question. Yes, sir.
This is actually a further answer. In visiting Cambridge, I visited the city and learned that two things are going on that are relevant to this question. One is the city of Cambridge has entered into a compact last May with Harvard and MIT, and it's a broad-based effort to address community development, economic development, environmental enhancement issues, but in a broad scale. It's not clear that it will commit either of those universities to think about how their endowments are used relevant to the implementation of the compact. That seems to be a possibility. The other is that the city of Cambridge, as many of you know, has entered into or created a task force called the Getting to Net Zero Task Force, and that includes MIT, Harvard, major real estate players, local real estate investment, and so on. And again, focused on getting to sustainability and how the university's assets, built assets, operate and may be modified to reduce carbon emissions. And I would hope that the kind of initiatives that these two things reflect will get both universities' trustees thinking, well, how do we manage our endowments to be consistent with what we are aggressively seeking to do, and how we manage physical enhancement.
Okay, we probably have time for one more question if we have it, or we can make an early transition to lunch. Yes, Tony.
A question that keeps coming up over and over again is the problem of commingled funds. If I heard that issue once, I've heard it at least a dozen times, talking to CFOs and policymakers. So if you guys could just comment about how you take the ESG ideas when you have maybe chosen a very successful strategy in the past of commingled funds.
Okay, so the question is, how can you apply ESG strategies if your investments consist of commingled funds? Does anyone want to take a shot at that? Alice, do you want to?
There are commingled funds available. Both the other panelists here have commingled funds available. Again, it's a more limited universe than we would like, but there's recently there's a global sustainability index put out by Northern Trust that has reduced their fees, so they're really competitive. We hadn't looked at them for a while because they were 60 basis points. They've cut to 30, so that's a more reasonable passive index. So there are funds available. I guess I have a question back to everyone, and maybe you can answer this: is the desire to only do commingled funds? I guess what drives that is the thought that you can't be in separate accounts because the minimum is too high, or that you don't want to pay the custodian. So I would argue that you don't need to only be in commingled funds. I think there's benefit to separate accounts. And certainly, if the more that you want to have meaningful say in what's in your portfolio, a separate account is better. And we have a few separate account managers that run portfolios for under $5 million in domestic equities-based minimum. You know, the $3 million minimum is what we've seen, and $1 million some will do it for. So I don't think you're unable to do separate accounts. So if that's what's driving that question. And the other part of it is you can know what's in your commingled funds. I think that some people have the idea that they can't know what their exposures are. They certainly can. And I think Tim could probably, from Walden, could probably speak more to whether you could vote based on what's in your commingled funds, but you could certainly have impact based on what's in your commingled funds.
So Alice, you could at least ask the commingled fund how they're voting,
Right.
why they're voting that way with your money, right? You're
That's
not
right.
gonna vote over the vote, you can vote over the account.
And as far as activism, Tim, I guess, can you not do anything?
Beneficiary, you can ask them to act on your behalf, you're not like to get that, a yes on that, but you're not the beneficial owner, so you can't file it.
So Geeta,
Letter, or join a Ceres letter as an investor, even if you're in commingled.
So if you had a group of investors who all owned X number of shares through their commingled funds, they could still have you write a letter that,
Write a letter, you just couldn't
file.
not to the beneficial owner.
can't
Okay.
vote the shares. So Geeta and then Mark with the last word. Geeta, do you have?
In terms of the commingled funds?
Yes.
Absolutely. I think that we offer many commingled funds. We create them as a convenience to our clients because of the custody and trading issues. But we can also do separate accounts, and I would say that given the broad-based concern has been that the environment social governance movement is made up of many small managers, and we don't have the size and the longevity and the traction. We have longevity. One of the good parts of not having huge size is that we can take on separate accounts. So we can't, on the one hand, we're smaller, but on the other hand, we're more flexible. And therefore, I mean, I think we may not be the sort of BlackRock or PIMCO out there, but we definitely can take separate accounts as well.
So one other thing I will add on the commingled fund, because we definitely hear that very frequently in our work, is many universities, especially medium and smaller sized endowment institutions, are either primarily or exclusively in commingled funds. I think there is potential here in this group and in this room to make some connections amongst specific universities that have the same investment managers and the same commingled funds. And if you could build, or we could build small sort of working groups of a half dozen schools that all work with that same investment manager, there may be a potential to engage with that investment manager, because I know switching investment managers can be very difficult, and sometimes it's a full stop for an investment committee or board that just will not consider a large-scale shift in investment managers. But there may be the potential to engage with some, especially medium and smaller size investment managers, to propose a tracking fund for your existing commingled funds. I haven't heard much about sort of tracking funds as potential. And so where you could have the same investment manager, the same investment portfolio, just minus a small subset, whether it be a fossil-free strategy or a broader ESG strategy, there may be potential there. A single client going to a manager, unless you're a very large client of that manager, may not get a very positive response. But a group of clients all going to a manager may yield better results. So maybe that's something that can be facilitated coming out of today, and would be more than happy to help in any way I can with that.
Okay, well, please join me in thanking our panelists.